One big change we've been seeing in the investment market in the last decade or so is the rise of ETFs, or exchange traded funds. And now it leads people to ask, should I have an exchange traded fund or should I still be invested in mutual funds? So let's dive a little deeper into the differences and similarities of mutual funds and ETFs. So mutual funds were started in the late 1920s and started to grow in popularity in the 1950s and 1960s, and then with the rise and the advent of the 401k, mutual funds really started to take off. Mutual funds essentially take a basket of securities in whatever category you're invested in. Let's say you're invested in large cap stocks. They will take 20 or 30 or 50 or 100 or 250 of single company stocks, and they will put them into a basket of funds. They call them mutual because they're taking on many investor dollars at one time, and you're all sharing in the risk and all sharing in the returns of whatever the mutual fund does. So let's talk a little bit about how mutual funds work. So mutual funds, the fund itself is bought and sold once per day. So if you put in a purchase or a sell or a buy of a mutual fund, you wait till the very end of the day for that transaction to go through. It's priced at the end of the day. So you will look and see a mutual fund will get the price at the close of the day. It doesn't fluctuate up and down. You get the price at the close of business that same day. Typically, they're actively managed. What does that mean? That means they have a mutual fund manager who has a team of investment professionals that are trying to beat the market. So they're not trying to stay with what the market returns will be. They're trying to do better than the market by actively managing it, actively trying to guess and pull the lever in which direction they think the market will go to try to beat the market. And they generally have higher fees, and they have a higher cash drag and tax implications because they sell or can sell at the end of the year. And let's say you bought a mutual fund in November and they decide at the end of the year to sell in December. Well, they may have a full year's worth of capital gains taxes. When they sell, even though you've only been vested for 1 month, you could get the entire brunt of that tax hit or the tax ramification. So that's a little bit about mutual funds. Well, in the 1990s, something came out that was called the exchange traded fund, which is very similar to a mutual fund. But let's talk about a little bit about how it's different, and then we'll talk about how it's the same. Most ETFs are traded throughout the day like a stock. So if you put in a buy or a mutual fund at noon, that transaction doesn't go in until when? The end of the day, and you get the price at the end of the day. On an exchange traded fund, if you put in a purchase at noon, as long as you can fill the order, let's say at 12:01 or 12:30 or 1 o'clock, you will get the price and whenever you put in the order. And you can buy and sell mutual ETFs, unlike mutual funds, throughout the entire day. Also, they tend to be passively managed. What does that mean? That means the manager essentially says we're going to try to duplicate whatever a market index does, whether that's the S&P 500 or the NASDAQ or you pick, and we're just trying to mirror the returns. We're not trying to do better, we're just trying to do similar. Now, actively managed ETFs have come into play in the last few years. Just like there are passively managed mutual funds, there are also actively managed ETFs. Generally, ETFs have much lower expenses because they're not actively managed. There's not as many people, there's not as many moving parts that you have to pay for, so your expenses are lower. Now, how are they similar? Again, the investment companies are pooling the assets, right? You share in the risk, you share in the upside, you share in the downside. We already talked about the basket of investments, right? There can be a number of different types. You can have a passively managed bond portfolio that's an ETF or an actively managed bond portfolio, but either way, it could be fixed income, it could be equities. The design of both is to have diversification, and they both charge fees. So the question is, which one is best for you? Is it a mutual fund or is it an ETF? The important answer to that question is it depends on what you're trying to accomplish. You begin with the end in mind. If my goal is to retire at 65 and I'm 40 and I have 25 years left, which of these is going to better position me to be able to retire with the amount of money that I want to retire with? If my goal is I want to take this money and in 5 years I want to use it to do something with it, to invest in a business, to buy a home, to put my kids through college, which of these is better? It really depends. Now, one thing to note is that ETFs have seen a pretty big influx of investments. In 2021, ETFs topped $1 trillion for the first time. And while ETF investments are going up, mutual fund investments are going down. In fact, many mutual fund companies are taking their mutual funds and essentially recharacterizing them as exchange-traded funds and then offering that to their investors. While we have seen a big inflow of ETF dollars, the ETF market is about $10 trillion. The mutual fund market is still about $23 trillion. So while ETFs may be the hot new thing, mutual funds have been the dominant player in this space for many, many years. So both of these are tools in the tool chest, right? And you have to decide which is best for you. If you have questions about your portfolio, let me know. Reach out, drop a comment in the comment section, or reach out to me directly. Both have their place. Both can be beneficial. It's about what are you trying to accomplish and which of these will get you to your end goal. If you have any questions, let me know. I hope you found insight on this video. Go ahead and give it a like. Hey, go ahead and hit subscribe. That helps us too. If not, we'll see you next time. Take care.